Welcome to this special edition, and I've got with me a very special guest. Jonathan Garner, Chief Asia and Emerging Market Strategist at Morgan Stanley, is joining me right now on the show. Jonathan, thanks very much for taking out the time, and it's a very interesting time to be in because you've actually started to see a lot of improvement in sentiment across the board, across various equity markets, not just emerging markets. You've got S&P 500, you've got NASDAQ trading at record highs in the last 1 year. India is up about 13.5%, while the MSCI Emerging Market Index is up just 7%. Do you feel that this is just a passing phase and this excitement may actually not be all that, will not probably continue for a longer period of time?
So I think whether it continues for a long period of time will depend on what happens to the global economy next year and to earnings. It's been a very tough 2 years for Asia and emerging markets, including India, in terms of underlying economic growth and earnings growth. And now the question is, will resolution of trade tensions, will policy stimulus that's in the system, including in India on both the fiscal and monetary side, will that lead to an economic turn-up next year? And we're getting a little bit more optimistic that that can happen. So from an emerging market standpoint, there are obviously various of the moving parts, and high-frequency data has been coming in from China. There is still a little bit, a growth issue out there, and the full impact of the tariffs have not yet been seen. In fact, some estimate that if there is no particular deal that has come upon in the first phase, the first quarter of 2020 could actually see a 20% impact of the tariffs coming in. So in light of that, how could investments be looked into within China, within emerging markets, within India? Well, as I mentioned, we've had 2 years of essentially zero earnings growth. We've had very meaningful downgrades to GDP forecasts over the last couple of years, including India. I think the Indian economy peaked at over an 8% growth rate. It's now tracking at something like 5.5% official, with double-digit declines in auto sales. So I think, though there are definitely these trade issues that are still out there, and it is interesting that India is not participating in RCEP, so that's something that's new. We do ultimately think that there is enough stimulus in the system. So in India's case, the corporate tax cut rates, the interest rate reductions, the state bank recapitalization, that we will start to see credit supply improve in India next year. And so my colleague Ridham Desai is expecting a significant bounce back in earnings from very depressed levels. And it's on that basis he has his 40,000 Sensex target.
All right. Since you mentioned the RCEP, let's talk about that. And what do you see as a repercussion to that? Because obviously India is trying to protect, the Made in India tag that we have, trying to push and make sure that they protect the domestic industry and farmers' interest. But from a medium to a long-term perspective, how do you view this?
Yeah, we need to do more analysis on exactly the reasons why India has chosen not to participate. When we saw President Xi visit Mr. Modi, we were interested in whether that was an attempt to put RCEP on track, as well as obviously talk about other issues. But it is interesting that the rest of the participants have chosen to go ahead, and so we need to understand better how that fits into the overall diagnostic. What I would say is that India has improved its openness to foreign direct investment under Mr. Modi's term, and we have seen a pickup in that segment of the economy and in capital goods that's orders related to FDI. So RCEP is just a part of the overall situation, but it's certainly interesting to have seen this development.
All right. Let's talk about, the recent development that happened, and we haven't spoken to you post the corporate tax cuts announcements, and we've already seen, the impact of that on the bottom line of companies starting to report in Q2. This is obviously a big positive.
Yes.
But in terms of making sure that this actually translates into something meaningful, where they can use the additional money to deploy into manufacturing, to boost capital expenditure, do you see that happening?
I think what's particularly interesting about the corporate tax cuts is that the rate goes all the way down to 17%, which is on a par with Hong Kong or Singapore. If you set up a new manufacturing plant in India, and so it is specifically designed not just to benefit existing incumbents, but actually to help with that capacity expansion, to encourage the corporate sector to take more risks. And even though we were just touching on RCEP, we should always remember that we are seeing a trend to supply chain diversification out of China by global multinationals, and that includes Indonesia, Vietnam and India that are benefiting from that. And so that element of the corporate tax cut is specifically designed to accelerate inward manufacturing investment, I think, in India.
Do you see India as being capable enough to make its place in the global manufacturing supply chain?
Well, historically, we've had significant weaknesses, particularly around ports, roads and railways. Telephony has been a strong point historically. But I think when we actually look at particularly some of the attempts that have been made to improve the road network, we are getting more optimistic that you can kickstart this sort of manufacturing FDI story, which has always been at a part of the Asian development model, and that needs to happen to raise incomes per head in India.
Do you feel that this is something that could also attract foreign institutional investors that have shied away from India for some time now? I mean, we've just about started seeing their interest coming back in the last 2 months.
Yeah, so if you look at about 6 to 12 months after Mr. Modi was first elected, that was when foreign investor positioning in India peaked out and people were around double benchmark weight for India versus the EM index. And that's not just the highest they'd ever been in terms of exposure to India, but also the highest we'd ever recorded for any major emerging markets in terms of optimism. So yes, it's dialed back from those levels to a slight overweight versus benchmark now, where it has actually stabilized in recent weeks. And again, going back to my colleague Ridham's earnings forecasts, 20% CAGR 2 years running off a very depressed base, that should be better than the average in emerging markets. And with the forward P roughly neutral versus history, this is why he and I have been recommending, even at this depressed growth and earnings environment, we have been recommending a modest overweight on India this year. And as you covered, it has outperformed, admittedly with some volatility, but it has outperformed year to date.
Which brings me to my next question. Even in these times where we've actually seen economic volatility, uncertainty coming in with regards to the trade talks, Brexit being an issue, India has still managed to outperform and outdo itself. We would have hoped for a little bit more, but we've made record highs on the Sensex. We're now approaching rescaling the record high on the Nifty. And obviously, all these measures that the government has taken is towards building a stronger foundation, even though it creates short-term disruptions. In light of that, do you feel that this is an opportune time to maybe, you said you're slightly overweight on India, but probably take it a step further to gauge a little bit more in terms of the long-term viability?
Well, we have to look at the totality of our coverage universe, obviously, to figure out our relative positions. And at the moment, we're quite happy with this modest overweight on India. What I would say is that the key, to some extent, to why the market has been resilient is the domestic bid for equities. And that's been consequent upon quite stable government bond yields and a reasonably stable currency this year. Very different, for example, from 2013. So one thing that I think investors, domestic and foreign, would acknowledge is that the inflation performance of the Indian economy and management of the external position has improved significantly in recent years. And that's a good plank for being constructive equities, and it's a contrast with some of the other countries we cover in our emerging markets universe.
So in the emerging markets universe right now, while you've given us your stance on India, which is the more preferred market currently?
So we're overweight Australia, Brazil, India and Indonesia. We're neutral on the large markets of North Asia like China, Korea, Taiwan. We're underweight MSCI Hong Kong, Malaysia, and also Mexico.
Okay, got that. What about the emerging market currency basket? I mean, we've seen the last 5 weeks particularly being positive for the emerging market currency basket. Do you feel that that's likely to continue, and what can you attribute that gain to?
Well, that's related to this whole debate about where the global economy goes next year, and obviously also the tendency of the US dollar to be somewhat weak now that we've had 3 Fed rate cuts, and we're clearly in an environment where the Fed has changed its overall policy stance. I think last week's comments, particularly at the press conference by Fed Chair Powell, really did suggest that we're unlikely to see the Fed going back to anything like a rate hike cycle for the foreseeable future, and that would tend to support traditional carry trade activity in emerging currencies. And as I said, with India's inflation well under control, its current account deficit well below 3% of GDP, with oil very range bound if not down, that probably means the Indian rupee can be reasonably stable.
Any near-term risks that you would like to highlight for us, Jonathan, that we need to keep an eye out on, especially from an equity market standpoint?
Well, we do think the market's now moved to almost fully discount phase 1 trade deal. So obviously, if that doesn't get signed, that would be a disappointment. And then we just need to keep tracking this pace of economic stabilization stroke recovery, which is very nascent, whether we really do see the kind of turn in PMIs that we saw in early 2016, early mid-2016, or not. And that's still highly debatable. The market pricing has moved ahead of the turn that may occur in manufacturing PMIs, but we just need to keep aware of that.
Okay. And one last question. At this current juncture, when we're looking at, and you've spoken about how important earnings growth is, but in India, it's a peculiar case where some companies, even with higher multiples, even with higher valuations at this point, are considered to be the safer haven stocks, and people start to invest in them despite the premium that they attract. In light of that, do you feel that it's still going to be the earnings growth momentum that's going to be driving more interest, or a tactical play on valuation mismatches that could be something to look at?
So we are getting more interested in value cyclicals, including in financials, consumer discretionary and industrials, and that applies across our coverage universe. We've been very much across our coverage universe holed up in sustainable yield plays based off the reduction that has actually taken place in long-dated government bond yields in the US. But we're starting to show an interest. We're starting to see an improvement in earnings in cyclical sectors. That's been more in the IT hardware sector so far, which is not that represented in the Indian market, but we're interested in whether that can actually spread.
Right. Jonathan, it was great chatting with you. Thank you so very much for joining us this morning.
Thank you.